All right, well, welcome to our latest edition of the Maslow Barside Chat. As always, I'm Matt Jachimiak, CIO and partner of the firm. I've got Isaac Thompson joining me today, our portfolio manager. Welcome again, Isaac. Good to have you. Well, let's just jump right in because there's a lot been going on in 2025. It's been a wild ride. Everything from Trump to tariffs to continuing conflicts throughout the world. It seems like it's a pretty stable environment for investing. Okay, maybe not, tongue in cheek. But what I would love to hear from you is kind of, how should clients be feeling about portfolios today, markets, and God forbid, should we be trading this market at this point in time?
Yeah, absolutely. I mean, I think the big story for 2025 clearly is tariffs. The breadth of tariffs, the geographies impacted, the goods impacted, the intensity of tariffs. We've seen rates over 100% floated for China, and kind of the duration of tariffs and the implementation timelines around there. Interestingly, we're sitting here at the end of May and markets are slightly positive on the year. So if you had simply ignored all of the headlines in 2025, you might think, hey, this is kind of a quiet start to the beginning of the year. And, if like the rest of us, you've been paying attention, there's been a lot of volatility, a lot of whiplash. And I think, it started in February. We had a weekend announcement of tariffs against Mexico and Canada. Monday morning, we saw a big sell-off. By lunch, there was news of a pause. And by Tuesday, it was like nothing had happened. This trend continued in March. It was steel and aluminum tariffs announced, and then kind of a moderation of the language later in the day. And that day ended up finishing positive. And then we get to April. And in April, we had Liberation Day, the big one. Markets were down, over 10% over the next few days. But a week later, we had news of another pause. Markets clawed most of those losses back. And, by the start of May, we were again back to flat to where we were before Liberation Day. And so now we're looking like we're going into June positive on the year. And so I think the takeaways are, number one, you can't really trade this market unless you are sitting in the Oval Office and, hearing those calls before the rest of the market. I don't think there's a reliable way to time in and out of this kind of market. And the second takeaway is the strategies that reliably have performed the best are the long-term allocations that you can stick with. The investors who did not respond, who did not try to navigate this market, but instead had a process they could stick by and an allocation they could stick by, they're sitting here going into June positive on the year. Of course, this conversation has been focused entirely on the US stock market, and there's global ramifications as well. But I think kind of an interesting underreported aspect of global markets is the performance of non-US markets. We have international developed up over 15% year to date. Emerging market is up over 10% year to date. And what's so interesting is it wasn't long ago that I was sitting in this very seat talking about how US outperformance has led the US markets to take a massive share of the global market cap. And our point then was that we're not going to chase the most recent winners. We're not going to alter long-term portfolio allocations based on who has done best recently. And now that looks fairly prescient. Our investors have benefited significantly from being globally diversified. But the point I want to make is that wasn't a prediction. We didn't think 2025 was going to have a outperformance from non-US markets, but more that diversification works. Having exposure to a variety of markets allows investors to achieve positive outcomes in a variety of scenarios. And so, as we think about these choppy markets, to me, it's a story of a long-term allocation and a durable portfolio. So I'd love to kick it to you and hear how you're thinking about, constructing these durable portfolios for these kind of choppy markets.
Yeah, absolutely. I think, the concept of a durable portfolio, I talk about it when we meet with new prospects, and I kind of frame it. And so it's probably been a while since a lot of the folks that watch this video have heard what we talk about in terms of durable portfolio and what that means. And so when I think about it, I think about portfolios that can withstand a multitude of market environments and economic conditions while avoiding some sort of permanent impairment of capital. Again, doesn't mean that we're going to always miss it, but we want to try and avoid it as best as possible. Now, I've said a lot of things, and so let's try and put it in like plain English so I can understand it because it sounded really good. But I think if we say it differently, what we want is we want a diversified mix of assets, so investment opportunities, where they will look and act and feel differently in different market environments, meaning that one asset may go up in a certain market environment while another asset may stay constant, may go down. But ultimately, it's that non-correlation relative to one another that will ultimately smooth the ride for the investor, so i.e. have lower volatility and will produce a meaningful risk-adjusted rate of return. Okay? How do we do that? Well, as I tell folks always, is that the simplest way to do it would be to start with two primary asset classes. One would be fixed income and one would be equities. Fixed income, as I've always talked about it, is really, it's that stable, asset, and it's the ballast of a portfolio when markets become extremely volatile. So we think that when there's a risk-off trade in the market, i.e. the market's heading lower, fixed income will buoy the portfolio, not only maintaining value, but in certain cases, like with treasuries, it might actually go up in value. So it's not a sexy asset, but it's ultimately one that we want to hold in the portfolio as almost kind of a portfolio insurance. Okay. The other asset would be equities. Equities are, as we know, it's the public market, it's the S&P 500, it's the Googles, it's the Amazons of the world. Equities for us will be the growth engine. And so if you, in a perfect scenario, if you could just take all of your investments, put it in a black box, let it sit there for the next 30 years, never look at it, never read a newspaper, and you open that box again 30 years later, you're probably going to have really good success because equities longer term will have much higher growth than just overall fixed income. The problem is it's going to be a very bumpy ride and nobody can just put it in a black box and never look at it for the next 30 years. So we think about these two things and in concert, when they work together, they absolutely will have non-correlation relative to one another in a multitude of market environments. Fixed income is probably going to do better in recessionary periods. It's probably going to do better in deflationary periods. Equities, it's looking for strong economic growth, moderate economic growth, even modest amounts of inflation. I know inflation is kind of a dirty word, but moderate inflation is not a bad thing for equities. And so those are the sorts of market environments that will be beneficial for those asset classes. When we think about our alternatives, so again, we think about real assets, we think about private equity, private lending, those will have different components or economic sensitivities inherent to them. Now, when I think about like real assets, so what are real assets? Those are things that you can look, touch, see, and feel, right? So like the building that we're in, potentially a toll road. Those are things that are essentially real assets. Well, those are going to do exceptionally well in probably most economic environments. If we have, a significant recession or depression, you'd probably see some impact. But strong, moderate growth, even modest recession, going to be fine. Inflation, again, will actually be good for a lot of these assets. If you're like a renter of an apartment, what happens in an inflationary environment? Your rents tend to go higher. Well, so the landlord then collects more rents. They then essentially are going to pay more cash flow to the underlying investors. So inflation's not a bad thing when you own a real asset. When we think about private equity will look and feel a bit like equity. The only difference is that it's private. And I know it's kind of a dumb statement. Yeah, it's private. I get it. But the difference is that they're going to have more tools or levers with which they can create value. So private equity is going to do well in strong economic growth, moderate economic growth, modest inflation again. I would even make the argument that private equity is probably going to do better in, modest recession or negative growth, as long as it's not, some sort of depression, in that you're going to have managers, think of like, the big players out there, the Apollos of the world, the Blackstones of the world. They have the ability to go into some of these private equity companies and actually take advantage of, certain economic malaise. They have the ability to cut costs a little bit better. They're not stuck on this hamster wheel of trying to generate a return for the next 90 days where a lot of public companies are, right? They have every 90 days they have to report to investors. And so it's counterintuitive that, private equity, you have a much longer time horizon. And so they think about it as such and they can create value on a longer term basis. The last one is private lending or direct lending. And, that's one where it's going to look and feel a bit like fixed income, but I would probably make the argument that it's probably not the ballast in the portfolio when markets get rough. It's going to do better in moderate growth, potentially even stronger growth. Uh, a lot of our private lending or direct lending is floating as well. So it is tied to certain interest rate measures like SOFR is one. And so if interest rates are actually going up on a short-term basis, that's actually going to be beneficial for a lot of our managers. And so private lending may not be the ballast, but it actually presents another fixed income opportunity that will look and feel different than our traditional fixed income like treasuries or even investment grade corporates. And so again, if we think about durable portfolios and kind of the market conditions that influence it, we're trying to find things that will look different and feel different in certain economic environments such that we don't know what will be beneficial, but we will find an asset that is performing well. And so case in point was earlier this spring when all the tariff talk was happening. And we're kind of scratching our head saying, like, what's going to work here? Something's going to have to work. And we had a great conference call with our industrial manager. I don't know if you recall this. And we were going back and forth about, like, is this going to be bad for us? Where are cap rates going and blah, blah, blah. And eventually a guy by the name of Scott Seeley, the founder of the firm, kind of looked at us and goes, I hadn't really thought about it yet, but tariffs are actually going to be really good for us. And we're taken back and we're like, why? And they're like, well, everybody right now is buying as much as they can and they're going to need a place to put it. And we are, case in point, the best place to put it because we're close to all the consumers in terms of all of our location of our warehouses. So in a weird way, tariffs are actually good for us. And so kind of looked at it, and we're like, that's really interesting and hadn't thought about it. And so again, it's kind of one of those things that if you have a lot of different economic tentacles out there, the way we do with our portfolio, sometimes like you're going to get these unintended consequences that will be beneficial to investors. And this industrial exposure was one of those, and it was very interesting. So,
Yeah. Well, I'd love to kind of double click on private lending. Maybe give us an update on Maslow Income Bridge Fund and where we stand there.
yeah, absolutely. And I know we've done a video on this. I think we released it last quarter. So I'm not going to spend a ton of time, but clearly you and I are really excited about it. Everybody on the investment team are really excited about it. We just had our second close on 6/1, and assets are starting to come in, which is exciting. We're over $20 million at this point. Our goal is to continue to get that larger. As we get larger, there will be scale associated with that for our investors. But we started with 3 managers, and now we're sitting at 5. And I would think by the middle of Q3, we'll be sitting at probably 7 to 8 managers. And we're doing exactly what we said we would do. And we're really excited about it. We'll probably make our first distribution at the end of Q3, and it will be an income vehicle just like we expected. So if you have questions about it, of course, reach out to me, to you, Isaac, or probably more specifically your advisor, and we'll have more conversations and see how we can get you in. But we're really excited about it.
Yeah, absolutely. Well, thanks for stopping by another edition of Barside Chat. I'm Isaac Thompson alongside our Chief Investment Officer, Matt Jachimiak, and we'll see you next time.